current high interest rate environment, the so-called higher for longer, is also coming at a time where of a more challenged economic environment. But these days, it's bad omen for private equity. There's no doubt about it. When we talk about private credit, we often use the term illiquid credit, which is a more encompassing, broader asset class.
Hello everyone, I'm Vincent and this is Resonance Spotlight, the podcast where we explore investment strategies, learn the story behind them and meet the expert who create them. Welcome to today's episode where we deep dive into the world of private credit, an investment category that has continuously held the attention of investors for over a decade, weathering the ups and downs of the global macroeconomic climate. The allure of private credit is undeniable, but it comes with its complexities, not least of which are the myriad of cryptic acronyms that can baffle even seasoned investors. Today, we aim to shed light on this field, exploring the why behind its prominence and exploring the opportunities that lie ahead. I'm delighted to welcome as our guest Saâdeddine Yahia, Investment Director at Resonance Capital. Saad leads our firm's illiquid credit initiatives, having dedicated over a decade to this sector. His experience spanned direct credit investment and strategic manager selection, covering a diverse array of structures and strategies. Saad, welcome to the show.
I'm glad to be here, Vincent. Thanks for having me.
So I may be playing the devil advocate, saying during this interview, and I don't know where to start because I'm lost. I think it's full of acronyms and buzzwords. So you have to help me. And so what do you mean when you talk about private credit?
So what the market means when they talk about private credit is the counterpart to private equity. So it's as simple as that. Bilateral, privately originated loans from a non-bank lender to a corporate, basically, most of the time. Not to the corporate directly, but oftentimes to the PE sponsor behind that corporate. That's where the lender relationship lies. When we talk about private credit, we often use the term illiquid credit, which is a more encompassing, broader asset class. It includes private credit, i.e. a loan relationship between a lender and a borrower, but also other strategies that can pertain to the world of public credit rather than the private credit only. That's the typical distress, and dislocated capital markets and so on. So if we had to map the private credit landscape, we think of it in three buckets, the same way like we use for hedge funds, three broader buckets. Lending, i.e. I make a loan, I look at collecting a coupon and getting my money back. Amortizing or bullet, that's up to me or to between me and the borrower, me as a lender. On the far hand side, or on the other end of the spectrum, we have the capital gain, which is the typical distressed and special situations. So lending, special situation, distressed and special sits, and everything in between, we kind of bucket it in the catch-all bucket, which we call opportunistic credit. So these are all the kind of specialty strategies like specialty finance, NPLs.
But Sad, before we go deeper into this variation of what you call illiquidity, help me. Long time ago, I remember there were these things called leverage loan. This was already a big market. So is it what we're talking about, or is there more?
Yeah. So bank loan and leverage loans are very similar in terms of the economics and the risks taken and the analysis to private credit. The only difference is that private credit proliferated in a different area of the market, which mainly consists of what we call middle market or smaller and middle market, stretching up to the upper middle market. In terms of EBITDA, this means companies anywhere between 10 million of EBITDA to probably, if you stretch it very far, can make 100 million of EBITDA or 125 million or 150 million of EBITDA. Those companies cannot access the traditional leverage loan market, the LBO financing type market. So, and that's what created this private credit as we know it today, which deals most of the time with middle market companies.
So,
And that's the
when I
background of it.
hear like big name asset manager launching like billion fund into that asset class, are they still targeting this mid market company?
Yeah, for the most part, yes. If a large dedicated asset manager raises a fund that's pursuing, let's say, direct lending, that's what they do. Basically, what they do is lending to PE, um, to private equity backed companies money. So that's all they do basically. There are some funds that do a certain proportion of non-sponsored back deals, but by and large, what drives the market is sponsored back deals. So that's what they do. The more multi-strats, the ones that we like to allocate, that do a bit of direct lending, but also a bit of distress and special situations, etc. These guys navigate in and out between private credit in the lending definition of the term, but also stretching out to public markets where you have discounted paper, process-oriented distress opportunities, and so on.
So I understand you prefer to talk about illiquid credit. You prefer to look at it from a larger point of view.
Exactly, because the only common thing across all of these things, it's not the credit risk, it's not the liquidity risk, it's not the regulatory environment or whatnot. Really, the main theme, if you were to find one common denominator across all these buckets, types of strategies within what we call illiquid credit, is actually the illiquidity of the strategy. The IRRs, the underwriting IRRs are hugely different, but the commonality between them is that these are very illiquid.
So what's the reason for this huge boom experienced by that market over the last decade?
Over the last decade, so the main boom over the last decade was twofold. So since the GFC, we experienced near zero interest rate environment for a decade. And there is a huge pool of capital waiting, the so-called yield-hungry investors. Large institutional investors were hungry for yields, which they could not find as easily in the high-yield market because those are driven by rates. And so this created this alternative lending market, or direct lending, or you can call it however you want, that actually offered a solution for large institutional investors to spice up their fixed income portfolios, basically. That's the main thing that drove the private credit.
And what role did banks play in that development? Were there...
They played actually... they played a big role by not playing a role. So after the GFC, tighter lending conditions, banks divesting from non-core assets, non-core activities, created a void, especially in this smaller end of the spectrum in terms of company size. So if you were a bank, you were incentivized to get rid of your smaller, often sometimes less profitable assets that were creating a burden on your balance sheet. So you exit the lending to the smaller companies, and that created the opportunity for non-bank lenders to step in and provide financial solutions, thereby charging companies higher interest rates, and at the same time offering attractive yields to those large investors that saw their corporate bond or fixed income portfolios not performing as they would have liked.
The boom was created by the zero rate environment. So now we have higher rates, and so what happens to that space?
Yeah. So if we were to speculate on what will happen to that space, if I am, let's say, if I'm a pension fund, I'm an insurance company, and I have a target rate of return that I need to generate on my fixed income portfolio, the attractiveness of the average plain vanilla direct lending fund may not be there anymore. because rates are, base rates are in the 5%, give or take, in the US. So maybe do I need to keep lending to smaller companies to generate my target return? I'm not so convinced of that. The current high interest rate environment, the so-called higher for longer, is also coming at a time where of a more challenged economic environment. And so can I keep affording to charge smaller companies high interest rate and ignore the potential risks of that? Not anymore. So really the way I see it is that the opportunity going forward to play in liquid credit in a high interest rate environment is more on the middle bucket, so opportunity credit, and the far right hand bucket, so-called distressed credit. Because we are primed for more volatility ahead. That's for sure. So lending is not so easy anymore as it used to be. It used to be low interest environment, booming economies, or for artificially booming economies. We can debate that. So that made for an easier lending game. Now lending is not so more easy. We need investors need to pivot to other strategies.
Okay, so can you help me? What's opportunistic credit?
So opportunistic credit is an area where we bucket the hard to classify strategies. Specialty finance, for example, could be its own category because it includes many different sorts of specialty lending, royalties, pharmaceutical royalties, music royalties, etc., intellectual property. So you lend against to companies that specialize in this area. There is another subcategory of opportunistic credit, the so-called NPLs, especially in Europe, where banks are behind the curve in terms of deleveraging and getting rid of their non-performing loan. So there are funds out there, asset managers that specialize on buying those loans and monetizing them, buying those books of NPLs and monetizing them. Private capital solutions is kind of where, for special situations lending, is where asset managers step in, provide a bespoke financial solution to a company to avoid it filing for bankruptcy or getting into trouble. So liquidity provider. Oftentimes by stripping out the most valuable assets and lending against those assets. And a final category, broad category that we place in there is dislocated capital markets. So this is your March 2020 Corona markets tanking. So it's more so kind of a public markets game where you pick up paper at a heavy discount when the opportunity presents itself. It's more sporadic in nature. So those categories are not present all the time. So hence the name opportunistic. They come and go. They're very cyclical. And now we believe it's the time to go after the private capital solutions and dislocated capital markets.
Okay, this seems all interesting, but you're describing, in your own words, a lot of sporadic opportunity. So how, as an investor, it's all good, but how do I build an allocation there? How do I fill up my book with what do I have to do to get there? To say I want to have X 100 million in that bucket. So how can I do that?
Yeah. So if you want to allocate and tick primarily all the boxes, your best shot is going multi-strat or trying to replicate the multi-strat portfolio through individual specialist areas. So the way we do it for our clients is basically we started off at a time with high volatility, building, at times of higher volatility, you might turn to distressed and special situations. These days we're talking about.
Are you talking about open-ended structure? So we're talking about fund structure. Is it still open-end or close-end structure?
So it's very hard to replicate a lot of what we're speaking about in open-ended structures. The reason for that is, and that's also the main reason behind which we insist on the word illiquid credit rather than private credit. So illiquidity, you might structure it in an open-end fund structure, as an open-ended fund structure, but you would have to gate, or you would have to place onerous liquidity terms on the structure itself. So it's a quite like closed-ended, effectively. Why we like the closed-ended structures better for this type of investments? It is because it affords the manager the luxury of time, basically, not to rush into investments, know that they can invest, harvest, and reinvest during the investment period as they see fit. And it locks in the fact of locking capital, not acting as an ATM for investors, alleviates the pressure on deploying capital on the managers and harvesting and collecting, harvesting too soon. And so to wrap it up, a bit of everything. If you wanted to get the best, the allocation everywhere, there are a number of multi-strat asset managers that do that well. Otherwise, you could still replicate every single component, but by going with the best managers you could find in any given area. Bear in mind that the other difficulty of that is that, contrary to open-ended structures, evergreen structures, managers open, they raise capital, then they close, then they raise capital, then they close. So there is this kind of vintage availability or fund availability for you to invest that is not present when we're dealing with traditional evergreen structures.
I keep seeing the higher for longer, this expression, higher for longer when reading about private credit. Well, what does that mean? What's behind that?
So there are a number of implications. The most risk management minded people will think about, okay, can the current corporate landscape withstand financing their businesses at LIBOR plus 8, where at SOFR plus 8, where SOFR is at 5%. Where base rates are at close to 5%. So that's a real threat to the economy going forward. It doesn't look so good for the economic backdrop. Talks of recession, talks of slowing growth are opening up, and that makes private credit inherently riskier, especially for the strategies that seek to lend money and get it back. So that game is not anymore easy. However, on the flip side of that, managers that are specialized in distressed, special situations, high volatility, process-oriented strategies, they would see that as an opportunity. There are walls of maturities coming up. It remains to be seen if smaller companies can actually refinance themselves at what seem to be a very onerous rates or interest at this stage. So higher for longer, a tale of two stories. Lending is very dangerous in a higher for longer type of environment, especially for the middle market and below. And an opportunity-rich environment should the economy hit a roadblock and start sinking. That's when distressed strategies come to play. And to your earlier point, is very good because it's very good to think in terms of, I want to be positioned a bit everywhere for all kinds of scenarios, hence the multi-strategy stack is better suited.
Saad, you've been allocating to a illiquid credit manager now for, I'll say, over a decade, So how has the ecosystem of manager, how did that change over that time? Were there many new entrants to the games with this huge opportunity set, or are the big boys of today, were still the leading player back then in the old day?
Yeah, no, it's definitely attracted a lot of newcomers, especially. So the biggest trend I would say is that you've had the big non-bank lending groups of the early days are still pretty much present. They try to diversify away into kind of more niche strategies, more opportunistic, more distressy type of strategies. So these are kind of newcomers into other areas, but traditionally they've been known for being non-bank lenders for a long time, especially the US-based guys.
Okay, so can you name a few for me, just that?
Well, I can name the likes of, Ares being one of them, Apollo running a whole gamut of strategies a bit everywhere, um, Blackstone and so on. So the usual suspects. Blackstone being kind of a PE pretty much company that started diversifying away into kind of this, private credit and the likes. KKR as well, formerly known for private credit only, that also came to the private credit space. So formerly non-bank lenders that came to this space, that stayed in this space somewhat. Formerly PE groups that also came as new entrants in the private credit game, and also hedge funds, namely credit hedge funds, the likes of Davidson, Kempner, Anchorage, and so on and so forth. So, and it keeps evolving. We see also some new entrants like Sona have also started with the credit long short type of hedge fund, and then now are offering a capital solution dedicated close-ended vehicle in the private credit space. So yeah, it definitely attracted a lot of new entrants.
I remember that about 1 year ago, some people were still, talking or concerned about an upcoming wave of default in that space, which, I mean, somewhere, at least on the surface, doesn't seem to have materialized. So is it still, is that the case, or is this risk still looming on that space?
Well, it's the biggest risk that never really materialized the way we were expecting. If looking back at the last decade prior to interest rate hikes and analyzing what happened during that decade, i.e. from 2008 till about till 2022, give or take, it's clear that whenever a maturity wall was coming up, a distress cycle, a default cycle was looming ahead, interest rates were so low that any company could refinance without any problem, and so avoid defaulting on their debt. And so the successive maturity walls or distress cycles were kind of kicked down the road. What that provided for is that it provided for a better clarity in terms of who are the managers who can find pockets of volatility and still operate within an adverse environment. So that 10 years of no distress actually provided a bifurcation or a dispersion between who are the real players, who are the knowledgeable specialists in this area, and who are kind of
okay,
not so specialized.
So you as an allocator was about to gather some data points on
exactly. It helped us greatly gather data points.
Yeah, that it was mentioned. I remember it was a big topic last year, big content. There's going to be this big wave of distress in private credit.
Yeah.
As far as I know, it didn't happen. And also the second concern was, okay, when this wave of distress is going to happen, okay, how is it going to work out, because it's new. There was this it's the whole structure that you have been untested in this in a big distressed environment. That was, I remember early last year, this was still a concern. This.
Yeah, that's right. And so when we talk to the various managers, they seem to be focused on this kind of refinancing. Refinancings coming up, these maturity walls that will ultimately have to be repaid, and given where interests are, it will be a more difficult task to pull off. I.e., we could start seeing, especially on the lower end of the market, companies having harder time accessing capital.
If you make good gain, they're buying the debt side of the company. There's the equity side. So if you make good business on the debt side, somebody else has to lose. everyone claims to be the winner.
So my gut feeling and my preparation is private debt is the new private equity. It's also like, it's also a topic that's heavily debated in forums, and in
Because
articles.
especially on the LBO, one is going to be the loser. Is it the equity provider or the debt provider?
When rates go up,
Yeah.
there is only one loser, is the equity provider.
Yeah.
That becomes more expensive. It eats away at cash flows.
But
And
it
so
increases the risk of
EV
bankruptcy. No, if debt becomes more expensive, the risk of servicing the debt is higher.
Hence our preference of being, with the higher octane guys, the guys who can lend, and when things go south, they can take the keys. Which is, if you look at our portfolio, this is where we operate. It's you lend, okay, you get your 15% IRRs on a loan. You carve out assets to get them as security in case of a default, and or you take the keys of the company if it defaults on you. But these days, it's bad omen for private equity. There's no doubt about it.
So why do you say it's bad omen? Because of the higher rates are bad omen, or?
So the current companies that exist that are backed by PE sponsors, these PE sponsors bought them at very high valuations in 2021, where we saw a surge in the leverage finance issuance. That leverage finance issuance served to acquire, serve private equity companies to acquire target companies.
So private debt has had this huge run. Investors have earned nice return on that, and so they are providing debt to companies. So my understanding, if somebody make a good deal, like on the debt side, somebody else, is going to get the shorter end on that part. So if the debt side is winning, who will be the loser? Shouldn't be naturally the equity provider.
It wasn't the case 5 years ago, 5+ years ago, 5 to 10 years ago. It was the other way around. Liquidity was abundant. Private credit just pulled that liquidity and deployed it into the spicier end of fixed income, which was direct lending. That's what they did. So as a private equity, you had plenty of choice in terms of who you will work with on the financing side of your companies. And actually, in parallel of that, equity valuations were going up in a straight line for the better part of 10 years, which means you were acquiring companies at higher and higher valuations all the time, but it didn't matter because liquidity was so cheap, you could afford to do that and still advertise, 20, 30% IRR on your private equity fund as a private equity sponsor. Where really the pressure came in is when base rates started to go up to fight inflation. That means that you could not anymore service your debt anymore because your company that you acquired very expensively may not be able to serve that type of debt servicing at those higher rates. So what has to give? Typically, equity gives because you will have pressures from your lenders, banks or otherwise to delever. You will most likely have breached covenants. And so the equity end has to give away. And we've seen it in many, if you follow this area of the market, typically us as investors, we would like that we try to make sure that our investment managers have the capabilities of taking over a company and restructuring it. And so while a plain vanilla kind of direct lending manager may not have the skills to take over, operate, and restructure, and ultimately exit a company, nor are they in the business of doing so, because what they promise their LPs is we make the best loans possible at the highest interest rate possible at the safest standards possible. So for 10 years, you've had Covlight because PE had the choice of who they wanted to work with, and the hunger, the eagerness to do business was more on the private credit side rather than on PE side. And now the tide seems to have shifted the other way.
Okay, thank you, Saad. Thank you for being with us today. I really enjoyed the insight you shared, And to our listener, thank you for tuning in to Resonance Spotlight.